All right, I think we are a go. Welcome everyone to another TresVista webinar. I'm pleased to be joined by the panelists here. And before we go ahead and give a quick intro, just wanted to provide a quick intro on TresVista and myself. So my name is Amir Jairazbhoy. I lead sales and business development for TresVista. And we are a global enterprise offering a diversified portfolio of services, including investment diligence, industry research, business development, fund administration, accounting, and data analytics. We work with a wide array of clients, including asset managers, advisors, corporates, and entrepreneurs. And we currently have over 1,300 employees across offices in Mumbai, Pune, Bangalore, London, and Singapore. And we provide high caliber support and operating leverage for over 1,000 clients across geographies and asset classes. So that being said, I'd love for the panelists to maybe take a quick moment and introduce themselves, and then we can kind of dive in from there. Maybe Dave, you can lead us off.
Glad to. Hello, everyone. Thank you for joining us. And Amir, thank you for hosting and moderating today. It's a pleasure to be here. I'm Dave Subhash. I'm a partner in the real estate practice at StepStone. We are a global private market specialist, and we help investors and managers work together in many ways as possible, primarily through primary fund commitments, secondaries, and co-investments. In aggregate, we have a very global client base and investment team. We advise and manage about 147 billion of real estate assets. This year has been very active. We expect to approve around 15 billion of primary commitments in real estate and about 2 billion of co-investments and secondaries. So very active deployment year that we'll talk about momentarily.
Great. Genghis, would you like to go next?
My pleasure. Thanks again. I'm Genghis Hadi with Nahla Capital. I'm a managing principal at the firm. It's a firm that I co-founded about 7 years ago. I was prior to starting this firm, I was at the Carlyle Group investing in real estate across the United States. Nahla Capital is a New York-based real estate investment firm. We own, operate, and lend on real estate assets across the country. We have assets in about 6 markets: New York, LA, San Francisco, Chicago, Philly, and Austin are the current cities that we're focused on, and looking to continue to grow the business over the next few years. And again, we invest, we also operate, and we also lend. So we have a very diverse strategy when it comes to real estate.
Great. And Matt, please go ahead.
Sure. Amir and team, thank you once again for organizing. Great to be here with you all. Mathew DeNatale, I'm a founding member of the Shelter Rock Capital Group. We are a 13-person boutique exclusively focused on the private equity real estate space. We are 13 people based in New York, and so while small, we do operate globally with a wide range of investors across the institutional investor universe. And we work with sponsors across the globe. So 150 different sponsors.
Matt, we're starting to
various strategies and structures. I've been.
I think you're back.
Can you hear me? So yes, so in the course of my career, I've worked on over 250 different sponsors. I've been in capital raising my entire 20-year career, really focused in on private equity real estate. Over the last 15 years, I was a founding member of the real estate fundraising practice at Lazard. While at Lazard, I was running their West Coast fundraising business for them. And then I've also had the good fortune of being in-house at Oxif. They were a former client of mine. I helped them raise their first institutional fund. And I've also was lead new product developments for them, anything that touched the private equity space for them. It's been a really interesting time in the private equity real estate space today. We've had some great success over the last 7 years, but watching everything through COVID has been an incredible eye-opener, and I look forward to discussing some of those themes with you today.
Absolutely, and thanks to everyone for that introduction. And Matt, I think that dovetails well into the next kind of kickoff question. So the topic that we're discussing today is real estate investing in the post-pandemic era. But I thought, what could be a good starting point is just, since it's a pretty broad topic, I thought we could take a quick look back, lead off with maybe everyone's thoughts on kind of what you've seen in your area of the market and your unique perspective of what's happened over the course of the pandemic. And especially from a performance standpoint, we've seen a lot of bounce back and maybe then some. But maybe what did you see in kind of the early days, and what are some of the factors maybe from an investment standpoint that have cropped up over the previous couple of years that might have changed the market or the way investors are approaching investments in real estate? And happy for anyone to kind of jump in on that.
Sure. I'm happy to kick it off, and let Dave and others chime in. But it's been the global real estate market has, particularly in the U.S., has proven to be incredibly resilient. And given the performance of what we've seen across asset classes within real estate, I think it's going to be continue to be a very meaningful portion of the institutional portfolio for folks. I'll touch a little bit about capital flows across investors, and then also we'll hit on some of the four major food groups now, and we can kind of touch on some of the more alternative asset classes later. But I'll break down COVID in really two phases, right? You think about COVID back in March of 2020. I call that phase one, where it was totally system shutdown for at least 30 days. And the snapback from that has been nothing like I've ever seen in any sort of recent cycle that I've seen, at least. Since then, here we are today, and there's incredible appetite for value add and opportunistic strategies. I would say 80% of the new capital that's being deployed is going to value add and opportunistic. And investors, the institutional investor community, continues to be underallocated to real estate. If you look at their portfolios, I would say 2/3 of them are currently underweight the sector per their own policies, right? And there's a few factors at play, right? I think people are really pleasantly surprised with the distributions they're getting back from their existing relationships. You have the denominator effect, right? The big move in the public markets. You have investors making tactical decisions around inflation, right? And also interest rates. And so if you're looking for cash flow, this is the best place to be. And we're seeing that not only across the big major large institutions, right? But we're also seeing that in some of the more family offices who are looking for cash flow, which we can kind of get to later on in the discussion. And then, of course, we're seeing an incredible amount of new entrants to the space. RIAs, multifamily offices, other wealth platforms, right? And they're hiring dedicated folks to supplement their existing portfolios where they have had existing, buyout and venture, and they've had success there, and they're looking to replicate that, right? So a lot of new entrants in the space. So, in terms of asset classes, you kind of think through the evolution of this cycle, right? Since March of 2020, I'll tick through some of the four major food groups, but multifamily and industrial, right? Like those have been the huge winners. Within multifamily, within residential, multifamily has been a boom, right? Like you think about the underlying fundamentals, rents have been ripping. This is, you kind of look at you talk to some of our relationships across multifamily, they've not seen anything like some of the underlying fundamentals they've seen. And then obviously, single family rental has been ripping, and it's hard to get access, but that's a space that's getting institutionalized. And there's so many drivers at play, right? It's getting institutionalized, a lot of large asset managers trying to get into the space, but also, the cost of ownership is so hard for folks right now in the US. I think the other interesting phenomenon around multifamily, which is interesting if you kind of think about these large dynamic markets and some of these growth markets, call it the Atlantas, the Nashvilles of the world. The folks who had dry powder during the crisis, the large asset managers, the big brand names, they were the ones who had to put capital to work, right? And they were looking for predictable cash flow. So they're going to safe havens in the multifamily space because they'd rather get a predictable 14 than shoot for the fences. So we've seen a lot of some of the valuation moves in the multifamily space because of that. And then industrial, right? Like there's the tailwinds around industrial have just reaccelerated. Everybody, you know, everything around e-commerce and the consumer behavior. And I don't think that's going to change, right? Companies need more space to meet demand. The cost of the last mile real estate really drives the need for smaller distribution centers. And then if you think about the distance to the end user, right? They're looking to decrease the cost of driving because of fuel and regulations around trucking. So there's many other factors around that as well. I think in terms of office, it's probably the big question mark in my mind, in sort of what happens there. I think the jury's still out. I think there's a lot of questions around what the lease structures will look like, how those spaces are going to be, you know, needed to be redesigned. We have investors poking around at the space, especially in the suburban markets. And we also have, and I think investors, there's money to be had if you have a long-term horizon and you're willing to fund short-term losses, right? And I think, you know, I know not everybody's going to agree with me on this one, and I might be an outlier, but I think the retail space has actually been the most interesting asset class to me to witness over the last 12 months. And that is because I think it's actually more predictable to underwrite than office, right? And I think people have been surprised by the underlying fundamentals. And there are drivers behind that, right? There's the omni-channel, right? So you think about the purchases of all online orders, 62% of online orders are being fulfilled at physical stores. And then you also think about the change of use at some of these local high growth markets. You know, there's necessity based. There's medical office in these places, food and restaurants, entertainment and fitness, and then they have these micro fulfillment centers. And then I think if you kind of call a spade, I think people are anxious to kind of get back out and have that shopping experience, trying on shoes and putting on glasses to get properly fitted. So we have seen an incredible amount of activity in that space. And it's also an interesting space because if done the right way with small managers, they can be nimble and get access to deal flow where some of the larger players can't get to, which I think is important for folks who are looking to access differentiated product. So that's I'd kind of leave it at that and see if Dave or others would like to kind of chime in.
I'd be glad to. That was a great recap, Matt. Thanks for that. To go back to Amir's first part of your question, what it was like in the early days of the pandemic, there were some things that felt similar to some prior corrections that we saw in real estate and big cycle inflection points. One being a lot of investment activity paused, not entirely, but as we saw from the data, transaction volumes plummeted. A lot of people, you know, sat a little bit on the sidelines to see what would happen, how this uncertainty would resolve itself. In the fundraising market, there was a big shift from before the pandemic was declared and shutdowns happened. Specified portfolios in a primary fundraiser were very attractive. Overnight, they became a liability, and regardless of property type, because people didn't know in the early days what would happen. In April, we went out to all of our clients with a letter sharing some thoughts and advice on how to navigate through this unprecedented scale of this crisis and uncertainty. And our advice had a few things in it, but key in it was that the best way for these indirect investors, who are largely our client base, to navigate through this is to stay the course with your strategic plans, maintain your vintage year diversification deployment, and maybe in your pipelines and in your near-term decisions, reassess those decisions on a tactical basis. And the result was a lot of LPs shifted away from specialist funds, from funds with specified portfolios, and this came largely across the board, regardless of property type specialty, which you know, in hindsight, everyone wishes they had loaded up on the sectors that Matt identified that are clear winners. That would be fantastic. But I think now that we're sitting near the end of 2021, and the recovery has been much stronger, and the government response and stimulus has been remarkably effective at staving off widespread distress, the investors who remained active with their overall deployment maybe shifted tactics a little bit more towards diversified strategies, let the managers be the tacticians for picking entry points. There's probably a little disappointment from people deploying capital that buying opportunities have not been at better levels with more distressed dynamics. But for the well-being of the economy and people's health, it's good that there is a lot less distress than was anticipated. However, the recovery has been very strong, so a lot of diversified managers have leaned into those product types that Matt was highlighting earlier. The specialists have done very well. Diversified managers have leaned into that. And now, as the pendulum swings back on investor preferences, we're seeing a lot more interest in specialists, in targeted strategies or managers that got real capabilities in some of these major property types that are clear winners, as well as several niche property types that are gaining more institutional acceptance, institutional ownership, and management. Are sought after by investors, both on a direct and indirect basis. So I think that's been the past 18 to 20 months in a nutshell. But I think our other panelists will have more to share on the transaction activity that he's been seeing.
Yeah, Jenkins, do you want to maybe chime in on that one as well?
There's so much to unpack with this question as it relates to COVID impacts, and I think Dev and Matt have done a great job kind of giving the macro view of where investors' mindset has been. I'll share kind of a memory of being in the middle of this, and being an investor and an operator. I have a little bit of a unique viewpoint, because in some deals I'm an LP, but in other deals I'm an operator. So when I'm an LP, I'm cracking the whip. When I'm an operator, the whip's getting cracked on me. And even more so, when you're an operator, you're dealing at the property level with the on-the-ground panic that's ensuing with your tenants. And one of the things that I just remember, I had several experiences during this pandemic that I'll never forget. One was the schizophrenic behavior of the lender community. We had term sheets ready to go, financing signed up that was about to, proceed to negotiation. That was February of 2020. And the lenders in the space that we were talking to called us on March 15th and said, we're out. And I just remember thinking to myself, that is a very fast reaction to a situation that we have no idea where we're heading. And it was just schizophrenic behavior. It was literally the only way I can describe it. It was, okay, we're out, we're in, our pricing's gone up. And it was true reactive. And then everything did calm down. So there was an element of panic that I think ensued in March and April that fortunately we've all forgotten about. And we've all kind of been able to work through. On the tenant perspective and kind of dealing with residential tenants and office tenants, that's been incredibly difficult, because we own a multifamily building in New York City. Our occupancy was down to 30%. We own an office building in Philadelphia. Our physical occupancy was down to 3%. Fortunately, our rent collections were high, and that was because tenants remained very calm with respect to how they were going to work through this pandemic and what was coming next. But there were moments there with occupancy levels being so low and continuing. I mean, if you look at occupancy levels today in major markets, at least in New York and in Philly, we're seeing physical occupancy. So not rent paying occupancy, but number of people within buildings as low as 30%. And so my concern with this pandemic is, and I can tell from most of the Zoom calls that I'm on that people are still working from home in a big way. And so the big concern I have with this is, where does it go from here, right? I think we've had a great outcome on a risk-adjusted basis with the real estate sector relative to other sectors. And I think there's a lot of money coming into the marketplace, which is very exciting. But if 70% of office users aren't back in their space, something's going to change, because the executive who makes the decision about paying $120 a foot in rent in New York City, or $180 a foot in rent in New York City, is going to scratch his or her head and say, this doesn't make any sense. I've got to change the way we do business, because it's your second largest expense as a business. Overhead of employees is your first, and rent is your second. And so that element to this pandemic, I'm a little worried about. With respect to everything else, I think it's the best industry to be in. And I think on a risk-adjusted basis, the right sectors that have been discussed by Matt and Dave today, multifamily, retail is an interesting one. We should unpack that a little bit. Maybe not on this call, Matt, maybe we'll do it separately. But retail is certainly an interesting one. And I think I genuinely do agree with you that urban retail and suburban retail will come back in some fashion. But I sit here in Manhattan, and you can see behind me, I'm on Madison Avenue, and the $1,200 a foot rents that we used to get over here are probably no longer for a while going to reach that level. So it's going to be more about how space gets repurposed, and I think that applies to the office sector, to the retail sector. And I think multifamily is going to do great, and for as far as I can see. So I'll pause there, because I know we're going to touch on other topics as we get into this. So.
Yeah, no, that was a great jumping off point, and I think it just speaks to kind of the breadth of this topic, and plenty of important points there that I think we'll touch on as you mentioned. But what I wanted to kind of dive into is one of the areas that you mentioned, especially given your presence in the urban markets in New York City, and as a New Yorker who works from home and lives in the city, I guess like most folks in urban markets who have contemplated moving to the suburbs, maybe up until last week where we had the announcement of a new variant, things might change. But I guess given that, there was a steady path towards the reopening and somewhat back to the office transition, albeit even in a hybrid situation, kind of how have you seen the trends around the residential market evolve, and I guess how are investors strategizing to capitalize on this recent phenomenon, assuming that it continues the way we've seen it unfold?
I'll start on this, and then let Matt and Dave add to the thinking. But obviously, being in New York City, and actually our investment thesis from the outset originally was focusing on urban gateway cities. So New York, LA, San Francisco were the first three markets that we invested in as a firm in 2014. These were also the first three markets to get hit the worst by the pandemic. Some of it was policy and how leaders handled the initial, political response to the pandemic, and then some of it is by the nature of the fact that if you're dealing with a pandemic and you're in such a dense urban environment, you're going to get hit the hardest. And there was everybody in March, April, May, June of last year, everybody was quoting the same data. It was the U-Haul moving data, right? That was the only thing that was available to understand where are people moving. And you could only see one thing. And I think I saw a heat map once, and you look at any of the major urban markets and the heat map was showing movement out. There was just zero question about it. There was a migration of people out of the city, and it makes a lot of sense. And that's when panic ensued amongst some investors. There's also a fundamental belief in your view on urban versus not as a form of living. I'm a believer that the urban markets are here forever, that cities like New York are not going anywhere, that there may be a temporary flight of people out of the city for tax reasons and for personal reasons. I don't think that is something long term that will destroy the city of New York. I think that for every person that leaves, there's probably two that are willing to come in and take their place. And I believe that through the pandemic. I know that a lot of people don't agree with me on that, and that's just a point of view that we take as a firm and as somebody who lives in the city and walks it and goes to the restaurants and experiences the cultural elements of New York, of Philly, of LA, and San Francisco. So what we've seen in New York is, I mentioned to you that we saw a huge drop in occupancy, and we really suffered through our multifamily ownership in the city. Well, there's a few strategies that investors can take. One is follow the others down to the bottom, right? Which means you reduce prices when the neighbor reduces prices, and you just keep following each other down. We took a different approach. we dropped ourselves to the bottom. We said, let's not play this game. Let's fill up the building and let's fill it up at where we think the bottom of the market is going to be. By doing that, we were able to get our occupancy very quickly back up into the 80% range. And as soon as the city started to get a grasp of the pandemic and have the infection rate under control, we immediately saw an uptick in occupancy and an uptick in rents. And we've experienced a 14% growth in our multifamily asset from pandemic to now. We lost about 18%, so we're almost back to pre-pandemic levels. And so that was fast, much faster than we underwrote. And we had to go to our investors and we had to say to them that this is how you're going to react to the pandemic. You're going to re-underwrite the multifamily investments we have, the office investments we have. We're going to take our timeline and we're going to do this to it. Okay, we're going to extend it. And the minute you extend your timeline in a city like New York, I believe it is a matter of time till the rebound gets you back to where you originally needed to be. And we're experiencing that right now. So our urban market strategies remain strong, but I would be silly to say that we haven't now started to lift our head up and focus on areas of growth, i.e. the Sun Belt. Phoenix is a city that we're very interested in. Austin is a city that we've invested in and continue to want to be in, although Austin we're getting kind of pushed out a little bit. So there is this flight to the Sun Belt that I think Matt and Dave will shed some light on. I'm sure they've got a lot of clients working and they themselves have worked on deals down there. But so we're balancing our portfolio between urban and second-tier cities, and I don't like to use that word, but secondary cities, let's call them. And I think that balance is the right one for us to find in our portfolio. I'm gonna pause and let.
Yeah, Dave, Matt, if you guys have any thoughts on that, feel free to jump in. Otherwise, we can move on to the next one.
I thought it was well covered, Genghis. Thank you.
Yeah, covered very well. And I would just say that those examples that he provided for a couple individual buildings he owned have been echoed by lots of landlords, managers that I know. There was an unprecedented drop in occupancy in multifamily rentals in New York City and some other major cities. But in New York, it was unlike anyone had seen in generations. The response was cutting rate, cutting better deals, more concessions. But anecdotally and even in aggregate data, those concessions have evaporated late this year. And so the demand is back. Probably the supply has been curtailed a little bit. I don't think many people forged ahead or started new projects. There's a smattering of them here and there. Still some groups are looking to convert some office buildings, which may be a good play. But I think that the limited forward supply and despite the waves of some new variants, absent a really dire situation, which would have to be much worse than the outbreak of the pandemic, I think that in the long term, cities like New York will have good demand for their both tenants and ownership of quality properties in the residential space.
Yeah, maybe adding on to that, switching gears to the commercial real estate space. I mean, there was a bit of a pullback early in the year, but that was probably across the board. How do you see the recovery here? As you know, we heard Jenkins talk about occupancy in offices and how executives are considering that as an investment, which is meaningful. But how do you kind of see the recovery here as offices try and balance productivity and safety, and kind of what do you see as key factors for investors in these strategies?
I would just characterize the office sector, particularly in major cities, as having a prolonged period of uncertainty, more so than other property types, partly because the lease terms are longer and people are paying their rents. So economically, you're not under pressure to be disposing of your assets. The lenders are not breathing down your necks, but your visibility on future demand is not very clear right now, except if you have brand new, very high quality property there's certainly been a number of significant leases, mostly driven by tech companies. Despite their flexibility on work arrangements, they have been actively absorbing space in the best quality properties. There is some transaction activity when you have one of those major high credit tech-oriented tenants. There's some appetite from investors to own that at pretty low cap rates. But other than that, there's not a lot of lease activity to look at in the broader office market. There's a much lower level of transactions than there has been historically. So price discovery is not very clear. Valuations are basically coasting along because there isn't enough observable data. It will take some time, and I think that the hybrid work arrangement is more of an experiment right now. We'll see how urban centers with dense competitive populations and businesses, despite what company policy says, whichever business model work arrangement gives you a competitive edge is more likely to win out. So if people are very effective working out in the Hamptons for on the shoulders of the weekend and they're getting business done, that will remain. If more business is getting done 9 to 5 on Monday to Friday in the city, that will probably win out. But I think before investors come back with a high demand for transacting in the office sector, there's a period to see some of these big drivers come into focus better.
Yeah. And
Yeah, absolutely. Oh, sorry, Jenkins. Go ahead.
Yeah, I would add a couple of things to that. I mean, one of the things as we operate some of our buildings that we're thinking about is exactly the question of how do we get people back in? What's going to make an employee want to come back to the office, right? And so the low-hanging fruit for us are things like air quality. So we now have air quality monitors up in our buildings. That way you can actually, as an employee, you can walk up to the floor you're on, scan the thing, and then it'll tell you some information that you previously never would have known, right? And we're trying to invest in technology that will help people feel comfortable about the space that they're working from. Air filtration is an obvious one. UV filtration is another one. Keeping space sanitized, clean, healthy, having amenities in there. That's the best we can do as an operator, right? Create an environment where employees feel comfortable so that when the CEO asks them to come in, there's fewer reasons why they couldn't come in. Back to the point of taking a position, unfortunately, I am one who believes fundamentally that you will produce better results, better returns when you're together in the office. Now, that doesn't necessarily mean everybody has to be there every single day, but I experience it myself. My team is all here. Everybody's in the office. We sit around the table ad hoc and we go through floor plans or we talk about investment strategies. I would never do a Zoom call for half of those meetings because it's just, I walk out the door, we have a conversation, everybody goes back to their tables and works, and then we do it again. So it's about creating an environment where my team feels comfortable that they can actually do that here in a safe environment. And so as a landlord, that's what we're really trying to invest in. We're trying to invest in ways to make the tenants feel good about coming back to work. Beyond that, of course, there will be some hybrid situation that I think is, and Dave's absolutely right, because of the long-term nature of leases, theoretically, we wouldn't and we shouldn't know the impact of this pandemic on office leasing until 5 years or 6 years from now, because that's when the lease renewals are going to start coming up. If you assume a weighted average lease term of 7 years in Manhattan, we're years away for knowing what the impact is going to be. The one thing we haven't seen a lot of in this pandemic, at least I haven't seen a lot of, is distress selling. We were kind of like, everybody was foaming at the mouth. You got over the fact that you weren't going to, once you realize, okay, this pandemic's there, it's real, it's happening, every real estate investor out there started foaming at the mouth, and there was emails going around, we're going to raise a distressed fund, we're going to raise a distressed, there wasn't that much distress. It was, everybody held on. And I think that, part of your question is, buy and hold versus fix and flip. And if you're buying and holding and you have the capital to withstand it, and you don't have sharky lenders, you weren't struggling through this. You figured it out, you know. Having the right capital structure, I think, was important for people.
Yeah, absolutely. And I think one of the elements you touched on there is the human resources element of having people being in an office and experiencing that in-person interaction and camaraderie. And that's something that we, also very much rely on, for employee satisfaction. And I think having some element of that definitely is important to the experience of those employees. And I think it's also maybe one of the things that I've heard is there's been a challenging recruiting environment, especially at the junior level, because a lot of onboardings have happened in COVID. Some folks still haven't seen the inside of an office. So I feel like as we kind of move through those elements, there might be some of those other kind of adjacent issues that start working themselves out as well. But certainly an interesting point. I wanted to change gears to the fundraising side of the equation, and Matt, maybe this can be directed to you. So obviously I think the broad telegraph message is that fundraising in real estate was down in 2020. I don't know how much that says on a standalone basis, but a couple of questions. I guess, what have you seen in terms of, has there been any nuance to that statistic in terms of, I guess, what leads to success in fundraising? And the second question is just trends on different types of LPs. You mentioned family offices, the RIA community. I'm curious as to how they've been viewing this space, and in terms of being underallocated, what steps they might be taking, as they kind of position themselves to come out of this pandemic.
Sure. Happy to take that. So, I sit here today and I see ourselves in, call it, phase 2 of the COVID cycle, right? And I feel like it really started 12 months ago. Whereas phase 1, you really saw capital being committed to the big core managers, right? For a number of reasons. One, they're good at what they do, but also in the virtual world, right? It's much easier to underwrite, right? They had, in many instances, existing relationships, either with existing real estate product or potentially product elsewhere in their portfolio. Controls, compliance, accounting, usually gold standard. And those groups are very easy to reference, right? The shift 12 months ago, those folks will continue to get the bulk of the capital. Let's be clear, right? And I do think that the fundraising statistics are skewed, right? I think you'll see a lot of the capital raised has been going to those folks, and a lot of that has been re-ups. But there was a shift 12 months ago. And so as I sit here, over the past year, what we've witnessed and what we're seeing investors do to set up for 2022 is they have their core managers, and now they're thinking about their satellite managers, right? And those are the groups where they're looking for alpha, right? Groups that can get them differentiated deal flow and product that they don't ordinarily have in their portfolio today. So we're seeing, we're seeing that happen in a few different areas, particularly in medical office, life sciences, cold storage, and actually a lot of that has to do with, there was a lot of good tailwinds behind those sectors in pre-COVID, but a lot of things, call it the labor issues, right, that we are seeing today, supply chain issues. And then also, I want to touch on a little bit about like the tactical moves people are making, right, to supplement their office exposure. Folks are going to life sciences, right? And so it's an easy choice, right, for folks who are interested in getting office type exposure in urban markets. They're going to life sciences because, as we've all witnessed, the biotech industry has evolved so quickly over the past few years, and it's really come under the spotlight during COVID, right? And if you think about the cost of real estate, right, to the overall cost of a biotech operation, it's insignificant, right? So they're totally price insensitive. That's number one. And then also, given the labor issues we're seeing, those properties are better off in more urban markets because of the talent war you're seeing, right? So there's many factors at play at life sciences, right? But those are some of the things we're thinking about and seeing in the market today. And then if you think about the labor issues, right? Like cold storage is one of them. Dave, I know, knows the space extremely well. We've compared notes multiple times on it, but it's a very fragmented market. It has yet to be institutionalized. I think technology, if implemented the right way, right, will help drive down labor costs. And the operators who really have good customer relationships and good customer service, I think will thrive. And then I also, if you kind of look at sort of the overall dynamics of the supply chain, right, it's incredibly resilient in downturns. So your downside looks much better in down markets. And then the other one I'll just touch on, and there's so many other emerging managers that we've been working on and seeing that are having success in today's market. And it's starting to get really exciting for us because this is where we focus in on. But one is that's benefited from the increase of vaccination rates is medical office, right? So I think that's out of the sectors that we're spending time on today, that's the one we've seen the best sort of uptick because of vaccination rates. But I also think it's a supplement. People are using it as a supplement to office. And look, there's a lot of pent up demand, right? So folks need their Botox, and orthopedic work has been put off, needs to get done. And things like orthopedic work is not something that can be replaced by telemedicine. It's not going to happen. If you kind of talk to the specialists in that field, it's very difficult, right, to be a telemedicine. So look, we work with managers who are small, nimble. They go after really small deals, call it $5 to $15 million check sizes. Very hard to access from the large guys. Yeah, so the large asset managers you can't access that. And then once you start aggregating that portfolio, there's incredible portfolio premium that you achieve. So investors who are yield hungry, you're getting a really attractive 8 to 9% coupon, and it's a really predictable cash flow associated. So like I think about those three asset classes alone that have changed. They were always benefiting, and then there's been slight subtle tailwinds that they've benefited from post-COVID. And so in terms of you asked about investors, right? Like the capital flows across investors, the REA multifamily office and these other large single family offices that act like institutions. Look, we've seen an incredible uptick in activity from those folks, right? And they're not only going and getting direct access to deals. Of course, they like direct exposure to call it multifamily deals and what have you. But we're also seeing them write significant checks in actual funds. And they're not just 20s and 30s, they're 50s, 75s. And I've seen a few instances over the past few years, and something recently at 150, right? So it's they're very meaningful in the LP marketplace today. They're hiring dedicated real estate professionals. They're very sophisticated. They act like institutions. GPs love working with them because they're extremely streamlined. And more folks are really kind of formalizing a real estate portfolio under the hood because they've seen the success they've had with their hedge fund and buyout portfolios, which, as you kind of think about the evolution of the alternative markets, real estate's always been sort of a laggard, right? So it's the natural next step of the evolution, right? So so that's sort of the highlights of sort of what I've seen in the emerging managers space, right? We love working with regional and sector specific groups who are finding differentiated deal flow today. And it's one thing to talk about differentiated deal flow, but the groups that are having success in the fundraising market today, you could talk about track record all day long, but if you don't have actionable deals, you're stuck in mud. So that's it's been really fascinating to see some of these folks have success over the last 12 months and talking to investors and thinking about how they're setting up for next year, because I think the appetite for those types of groups, the sector and or regionally focused groups, first-time funds, the emerging managers, I think they'll continue to have success going into the new year.
Yeah, no, it makes absolute sense of having sourcing as a differentiated factor. But Dave, I feel Matt kind of set you up for this one already. But there was a couple of things there, so maybe like a twofold question. The first was the mention around kind of the realm of alternative real estate investments like life sciences and healthcare facilities. So curious as to your thoughts there, but also just generally, as an LP, I think you mentioned getting into the virtual diligence phase and kind of running through that with not just existing allocations, but also looking at emerging managers. So curious as to just your thoughts there overall from a fundraising or an allocating standpoint as well.
Yeah, so in the first part, on the rise of alternatives or alternative property types, I think that's true in the fundraising realm as well. It's not just the demand from direct buyers, but also the indirect LP community wants more exposure there. And I think it's just part of a longer term trend. There are some property types, especially if they have the scale and the resilience through cycles, I think they've got pretty good tailwinds for the next several years. So we may see more variations on residential rental strategies, property types, continue to gain more exposure in institutional portfolios, both on the high return value add opportunistic side and on the core plus side of their institutional portfolios. And I think that because there was not widespread distress and as big a dislocation as there was in the GFC, many established investors who've got a broad stable of managers don't have to do a tremendous amount of replacements and swapping out of managers who lost capital at the fund level and you know in the 2005, 6, 7 vintages, top quartile in some of those years was returning a low single-digit return. The median might be losing some money and not even a full return of capital. That's not the situation we're facing today with people who are heavily invested and deployed right before the pandemic. You will, however, see a bit of a stratification of, and this is more driven by property type as the dominant variable rather than necessarily individual deal selection or location selection. Property type has been dominant. So the managers who have a lot more exposure to multifamily and industrial came out very well. Those that continued to have some hotel exposure or even retail exposure, which was waning in the years before the pandemic, will probably appear to be relative underperformers, even if they've shifted their pipeline and recent activity quite considerably. So the bottom line is, I think it's hard for a new manager to make a case for being added to investors' portfolio unless they complement the existing exposures and offer something new, which is largely in those alternatives that Matt was highlighting. So I think that's really a sweet spot for new fundraisers, new managers. Your question on diligence, certainly with travel restrictions and people working remotely and not in their offices, there was a requirement that diligence shift to a virtual environment. At first, it was limited to a lot of existing relationships and re-ups. Then it began to be applied to some new relationships. I think going forward, some of that will be here to stay. It brings some efficiency to a very inefficient process for the fund managers and to some degree for the investors too. You can have a wider group of your teams participate on both sides in the diligence sessions without as much friction on coming in and out of rooms and preparing printed materials. I think it works very well, but the need for in-person meetings to establish new relationships is still important, and I think that will be critical for a lot of new managers to gain spots in investors' portfolios, and especially in a lot of these alternative property types, being able to see them and walk through them firsthand can really have a bigger impact than any visual presentation you can do virtually with prospective clients. So I think that we'll see a shift towards more of the in-person meetings happening for condensed portions of either building the relationship. Maybe it'll be less formal. Maybe it'll be for certain topics, but a lot of diligence activity, I think, is going to be streamlined through virtual technology.
Yeah, absolutely.
And managers.
Yeah, I mean, to your point about folks coming back into the fold with in-person meetings, just from recent events and conferences, I've definitely seen some of that, although some part of it is still virtual. But I think to your point, it's being used as a way to be more efficient, in the whole process. But no, that's definitely interesting insight. Genghis, going back to maybe one of the points that you mentioned earlier about the lender community, one of the things that just debt financing trends have been, in the forefront, and institutional lenders, you mentioned that have been pulling back, LTVs have fallen. So like, while GPs can make some of that by raising more equity, what lucrative sources of debt other than that can they seek? And generally, what are your thoughts on how that's going to evolve?
So, I have my experiences with this. I definitely want to hear from Matt and Dave on this topic, because I think they see a lot more. As an operator, we operate in this little void of, we're trying to get deals done. And the experience I've had with this, and the reason we became lenders as well, is because there was a point in the cycle pre-pandemic, nothing to do with the pandemic, where we saw valuations increasing. As investors and operators, we didn't feel like we were going to be competitive at the price points where transactions were trading. And so instead of, as a small firm, we're a boutique firm, we're only 9 people, for us, not investing for 2 years means the death of our business, essentially. When you're a large organization, it's very different. So we looked at the space, and we kind of understood that this is 2018. We understood that there was a gap in the financing availability, bridging post GFC, where leverages were very high. I think there's been a consistency in lenders being more conservative about who they lend to and leverage levels that they lend at. And I don't see necessarily that pre and post pandemic that's changed drastically. I think lenders have been significantly more responsible in this cycle than they were in the last cycle. So what we identified pre-pandemic was a gap in GP capital structure, where lenders were going up to 60, 65%, and they were being more conservative, and GPs were used to raising more like 20% equity and not 35% equity. And so we were plugging that gap as an investment opportunity. We were coming in and providing mezzanine debt in transactions, and we were doing really well at it. That space got very crowded very quickly. All of this is pre-pandemic. Post-pandemic, I think you're correct in saying that the already conservative lenders have become a little more conservative, but there is still ample cash out there. There's a lot of debt proceeds and debt funds that have capital to deploy. So the right transaction, the right location, the right sponsorship will get financed. And the question you're asking is it financed at 60% or 70% or maybe even higher than that? And I think there is capital available today to bridge those gaps. It comes in the form of either pref equity or mezzanine. And I think sponsors are taking advantage of it. And I think it's, in my experience, it's actually fairly similar pre and post pandemic in terms of where the lenders are. It's just different in the sense that they're being more conservative around their underwriting and which transactions they take on. I'd love to hand to Dave and Matt to see if they have any different experiences on that. But that's kind of what I'm experiencing.
I can't say that it's significantly different, but I can amplify that message that the traditional lenders, banks, and the securitization market have a lot more discipline and limits to what to lend on and how far up the capital stack they'll go. So the gap has been filled by a lot of private lenders like Nahla, and even a lot of the very large managers now have debt fund series or programs. So it's an attractive space for risk-adjusted returns, to use an overused phrase, but it also is appealing to parties that want to have exposure to long-term exposure to certain property types that may be impacted but are not trading at distressed levels. You might like your basis as a lender better than you would get it as an equity buyer today in some property types, office being a good example. And banks may be less enthusiastic about lending on a lot of office, particularly in gateway cities. So I think there is capital available. I would say that the total amount of borrowing you can do as a equity sponsor is not as high as it was in the era right before the GFC. even when you're talking about stretch senior or having some kind of mezz bridge, it's not getting quite up to the nosebleed levels as pre-GFC. And the difference, a key difference, is a lot of times the lender who's providing that stretch senior or above where the banks would provide it are institutions that have a lot of direct ownership experience and operating experience. They're often fund managers themselves. So I think that while it's not poised for a wave of distressed debt and defaults today, that's not visible on the horizon. Should that happen through exogenous events, I think you'll have some pretty capable lenders who have gone above the 50 or 60% LTV level, who can step in and even maybe not necessarily foreclose, can also provide a lot of constructive guidance to resolving issues.
Yeah, I mean, the one thing I would say, Amir, and it's hindsight is 2020, but in the 18 months from 2020 until mid-year this year, if there was, there was a panic mode for lenders where they just froze up and they said, we're not lending. In that, it's not even 18 months, in that 12-month period, if you had capital to deploy, you would have, and you were confident in knowing that the world's coming back, you could have deployed billions of dollars in the debt space and done very well in it. Now it's, we're, while the pandemic is very much in front of us and it's still here, from a lending and borrowing and investing standpoint, it doesn't really feel like, it's a forefront consideration in
right.
where we sit in December 2021, and I hope that continues.
Right. Yeah, and another benefit of hindsight would have been knowing that there wouldn't have been as much distressed assets out there as people would have expected. But so I know we're coming up on the hour here. Just a couple of more questions. The next one I think is very topical, and it's about the social impact. And it's definitely becoming an essential aspect and a topic of conversation in the asset management industry. The focus on ESG, sustainability, diversity, and inclusions. All of these are very topical today. So I'm curious as to hear, and this probably applies to the whole panel. But what constitutes a successful effort on developing a framework around this area? How do you evaluate the efforts here? Both from when you look at managers, maybe from an LP standpoint for Dave, or even an investment opportunity standpoint, for Genghis. Happy to have anyone kind of pick that up.
Sure, I'll maybe tee it up and hand it off. It's something, social impact and general ESG themes have gone from being something that people did selectively to something you almost have to do to attract institutional capital today.
Right.
It's not exactly a binary threshold right now at this moment, but it is something that's looked at and evaluated by an increasing number of investors in all different jurisdictions and investor types. So it's been a full ESG diligence and screening has been part of our process for all primaries or co-investments, and even to the extent we can in secondary situations, especially the LP secondaries, it's more limited, but in GP-led secondaries and recaps, we have a very thorough process for ESG factors. We do that regardless of whether a specific client requires it or is evaluated on a score, but it is becoming increasingly important. And managers, I'm sure Genghis can talk about this in his own firm, are figuring out ways that they can set a good policy, incorporate it into all facets of their business. These are the things we're looking for. And then today, I think the most important thing is that you are consistently monitoring and measuring your progress on social impact, on environmental impact, on governments, and even diversity as well. So all these things are the first step, which is part of a longer journey, is making sure that they're implemented and measured and improved upon over time. And later you may start to see them become a more binary factor. If you don't have a policy, an ESG policy, or you are not evaluating sustainable factors in your investment and asset management decisions, that may start to become a binary factor in whether you'll attract certain types of institutional capital. But today, it's really about making sure you're set up to do it and measuring some progress.
I think that's absolutely right. I think there's two elements from which we're looking at, maybe three elements from which we're looking at this. One is, first of all, it's the right thing to do as a real estate investor, owner, operator. One of the biggest imprints we make as a human race on the planet is the buildings that we put up, right? And so trying to get that carbon footprint to be neutral is something that is our responsibility. So that's one very important aspect to doing this the right way. Two is obviously, as Dave mentioned, investors will start to require it. And when investors start to require it, if you're scrambling to figure out what your strategy is, well, they're going to go to the group that's already figured their strategy out. Three is employees. This generational shift that's taking place. The younger generation put this as their number one issue and concern that drives their thinking. You're seeing it with the different outspoken young people in the world today, and how important zero impact environmental consciousness is weighing on them. And we're being asked that question when we're interviewing people for jobs. What do you do as a firm for the environment? And then three is your tenant base, right? So it's your employees that you're trying to attract. It's doing good because you should. It's the investor community, and then it's the employees and the tenants. And there will be a time, I can't tell you when because I don't know, but there will be a time where large occupiers, and they're already starting to do it, will look at buildings and they'll say which building is doing more, which building is more conscious. Now, these concepts have been around. LEED has been around, Energy Star has been around, and it's really about making it more of an impactful and real change as opposed to a marketing change. And I'm not saying those categories are marketing changes, but there are a lot of operators and a lot of groups that have put logos and things on their building because they just want to satisfy, and check a box. Well, I think it's shifting now to actually auditing what it is you do. How are you sustainable? How do you get to net zero? Do you actually recycle, or do you have two recycling bins and all the trash goes into the same, into the same receptacle and then sent out? So these differences are going to play in the mind of everybody that you touch. Every stakeholder within this, experience of real estate that we have is going to care. So us as a firm, we're spending 6 months establishing a policy, going through how we can meaningfully make a difference in our investments. And it's not an easy task, and it's a task that requires people with real experience in it to guide you through it. It's going to play out in every aspect of the business. When you select a contractor, when you select a vendor for a building, what do they have as part of their policies? So if you can start, if an investor puts the requirement on the operator and the operator puts the requirement on their vendors, you start to get a circular economy that makes a lot more sense. I'm part of this association called AFIRE, the Association of Foreign Investors in Real Estate, and they do a poll every year. And I was flipping through this poll just now, and net zero environmental concerns fall very, very high on this list for these investors. And I think this is the first year that they rank up at the top. ESG and climate change are amongst the top issues of concern right now that have been voiced by some of these foreign investors. And so I think it would be foolish for us as a community to not pay attention to this, not to mention that we're just coming out of a pandemic, right? So it is a good time to self-reflect and figure out how can we create a better environment for, all of us to live in. So I think it's highly relevant, highly important, but I do agree that how it plays out is going to take time. People need to figure out, you can't convince an operator to spend 30% more on a specific vendor because they're more, net zero or they're more environmentally conscious. So how can you do it where you have actually a cost benefit to it beyond, there's the economic aspect that one has to pay attention to.
Right, absolutely. And Matt, I'm curious if you've seen any kind of discernible trends when managers are positioning themselves and their strategy around ESG, and maybe any elements that have led to more success than others.
Sure, happy to kind of chime in. Yeah, so look, there's so many folks moving in that direction, and some are doing it the right way. And I think the ones that have success are the ones that have shown that they've improved their processes along the way. They have a dedicated team, right? And I think that's critical, right? And making sure it's you have folks who are really actual stakeholders in the firm and driving the initiative, right? And it's not you're not window dressing, right? So it's a combination of one, improving processes along the way, team, and then also being able to quantify those results, right? And showing the investor how well you've done, and having a scorecard for yourself.
Yeah, no, that definitely makes sense. So I guess to round everything out, we can pull out our crystal balls at this point, and I think given everything we've covered, it'd be interesting to hear the panel's thoughts on, I guess, just the overall outlook for the industry, and maybe one or two trends that you think will, be key drivers. I think one thing that we just talked about, which is the ESG impact, is something that I feel everyone agrees on. But aside from that, if there are any other trends that you think will shine through, or things to pay attention to as we look towards 2022, Matt, would you like to lead us off?
Sure, I'm happy to start and have others chime in. So look, I think barring any major move in interest rates or any sort of geopolitical risk out there, I feel like next year is going to be similar to this year's, but probably a little better. But look, I think, despite what sector you're going into in real estate, right? I think it's all about manager selection, especially where we are in the cycle today. And there's 4 things that are critical to the underwriting. And I think 2 of those are more important now than they were in the beginning of the cycle. And obviously, track record, right? Proving out, do they have the exits proven out? Do they have proven exits in the opportunity set that they're going to go pursue? Manager alignment, right? Is the manager hungry? Are they aligned with the investor? And are they creating strong incentives across the team? Is it evenly distributed, right? And then, especially where we are in the cycle, look, risk management. How did they manage their properties during COVID? Not only how did they manage the properties, how did they report to the investors during that time of stress? And that's, I think, critical. It's a real show of character and manager in how they were transparent in reporting to the underlying investor. And then one of my favorites, and the one I've screwed up a couple of times myself because you don't always get it right, is the life is too short rule. And I have a rule: if I can't have an enjoyable dinner with somebody or introduce them to my family or other people, and I'm embarrassed, I could be embarrassed, then that's where I've made my mistakes in the past. So that's at Shelter Rock. We have a couple of things that we tick through. That's number 1.
It's a good golden rule to follow.
Yeah.
Jenkins, would you like to share your thoughts on that question?
It's a question that we think about all the time, because it's a question that investors ask us every day. What's next? Where are you going with this? What's the strategy? And of recently, so when I started the business, we had a strategy very clear. We had a mandate. We knew what we wanted to do, and that strategy evolved over time to be proactive and be ahead of the market with respect to where we thought the cycle was heading, where we thought fundamentals were going. And I think we did a pretty good job as a manager of getting ahead of the game. We shifted into the debt space when we thought that the equity markets were overpriced. This is the first time in my career that I would say to you, our strategy is specifically to be strategy-less, to be responsive, to keep our head up, look around, understand what's going on, but to not try and force a strategy into the next, let's call it 12 months, because I don't really know how things play out. And I think everything that Matt just described is what we're going to try and do to raise capital and deploy capital is really use our strengths, be aligned with the investors, find good deals with good fundamentals, not stretch. We're not a fix and flip firm, and I don't think real estate is a fix and flip industry at its core. I think that real estate really is something that is meant to be medium to long term in its hold profile. So that is definitely a focus for us, is to not find deals that need to be in and out within 2 years, because I don't think that that's more luck than it is anything else. I think we really want to focus on investment strategies that can be 5 years in horizon and even up to 7, and aligning ourselves with the capital that is willing to do that. And we're also going to be making sure that we try and limit our exposure to construction, because we have a lot of it right now, and what we're experiencing is very painful. Construction costs are going up every 30 days. And so we want to hedge against that and be out of that space right now. And that's a direct impact of the pandemic. Supply chain issues is something we didn't really touch on here, but supply chain issues and the cost of raw materials are through the roof and continuing. I mean, we get quotes in for parts of our construction projects, and the quotes are only good for, in some cases, 2 weeks. And that's because they know, as a vendor, their costs are going up. They're having shipping issues. Their containers are sitting at, in a port somewhere stuck. So the short answer there is try and move away from the enormous amount of construction exposure that we currently have, and focus on income producing real estate. Of course, and I hate to say this, but I have to, a sector we've looked at for 6 years now, have unsuccessfully we've not been able to break into it, is the life science sector. We've studied it deeply. We understand a lot of the fundamentals of it. We've just not been able to pull the trigger on the right deal. And that is a sector, again, in the right location, with the right type of asset, that I think is the future of medical office and office space, quite frankly. And I think that's a sector we want to continue to keep our eyes on for the long term.
No, that's helpful. And Dave, would you like to round us out?
Yeah, I'll try to be quick because I know we're running long here. So I think Matt's points were excellent, and I would add to it that while in this part of the cycle, property type has been the dominant variable, investors should keep in mind that for the medium to longer term, asset quality and location will be important. So there might be a rising tide that's lifting all types of industrial right now, but at some point, asset quality and location are going to be delivered noticeably different, meaningfully different returns. So be conscious of it. And then to managers, I was going to add something, and Genghis touched on this himself. It's really important to pick proven managers and sponsors especially for a lot of these alternatives. So alternative property types that are newer, they have a less deep pool to choose from, and a lot of times these property types have more operational, more sophisticated operational requirements and mechanical and design specifications. So it's not always going to have the best results to pick somebody who's new to it. Some managers who are jumping in to just get deals done will have some lessons to learn along the way. Others, like as Genghis described, are being very thoughtful and careful about their approach to something like life sciences, which is really important, because you don't want to get involved with something until you know what you're doing.
No, absolutely, and I think we did run a little bit long, but it was a great conversation, and I hope our audience thought so as well. We'll make a recording available shortly, but I want to thank the panel for sharing their time and their thoughts and insights here, and look forward to viewing the replay, and I hope everyone enjoys the rest of the day and the week.